let's assume OpenAI or one of them is successful.
Yeah.
Okay. So they figure this out.
Like AGI.
Okay. They get to the
Singularity.
goal.
Yeah.
What happens to the chip companies then? What happens to the picks and shovels then? You know what I mean? What is the roadmap?
You're such a pessimist. On
I don't
all
know.
the AI
I'm just
stuff.
saying.
You're always doom and gloom on the.
I'm just saying.
I'm gonna be positive. Like, what if they do it and we cure cancer? We go to the moon.
Start it up. Let's get it rolling. Big ideas, money folding. Hustle smart, dream so wide. Turn that grind into a joyride.
You like money, Chris?
I do like
Today
money.
we're going to be talking about lots of money.
Yeah.
And namely, some kind of interesting behavior. I wanted to take on the topic of are we the AI stuff? Is this a boom, a situation and a big bubble in danger of popping at some point in the near future? Or is this kind of the real deal? And I can see a couple different sides to this. So I wanted to run at this. We don't do many like investment style pods, but this one will probably get into that a little bit because there's been some interesting market
This is kind of like a self-preservation investment pod. And I think you and I were talking about if like anybody that's holding stuff in the market now has probably seen their portfolios go up significantly. Mm-hmm. And so we're looking at the nice green number that's like, hey, your portfolio, your portfolio is worth X% more than, its book cost. And you're kind of sitting there and you're like, wow, that's awesome. Like, and you've asked me a bunch of times, like, when do we sell?
Yeah.
Okay. And it's kind of like,
it's
like
the millisecond before the bubble pops.
Exactly.
Right?
Yeah. And I feel like everybody's kind of like asking that question. So, I wanted to kind of take the approach on this episode that, hey, we're so smart.
Go on.
That why don't we go back and look historically what the indicators were that would lead to a bust, a bubble popping, okay? So that we can be the ones like a millisecond before the bubble pops, we're out of the market.
Can I set
we're
the table?
All cash. Okay,
Can I set
the table.
So a couple of things. I think it was I think Graham might have just fallen out of a chair. You all right back there, Graham? He's all right. So I want to talk about the first element here is the circular investment piece. So let's talk about the scale of this money. So OpenAI is leading a $1 trillion build out of compute and data center capacity.
That's crazy.
It's fucking believable. Okay, they have deals with AMD, NVIDIA, Oracle, and CoreWeave promise over 20 gigawatts of computing power. This is the comparison, about 20 nuclear reactors worth. 20 nuclear reactors.
So is a nuclear reactor, like when I watch The Simpsons, is one of those cooling towers, is that like one reactor? Because I think they had two.
Presumably,
in
they had two in Springfield. So that's a lot.
So like 20 of those cooling towers?
40 towers right now? Wow. So the electricity alone could cost another $1 trillion over the next decade. So holy shit. So then after that, NVIDIA makes a big deal right now. So I guess the first part was like, that's crazy. Like the requirements. The second part is like how the vendors all have a relationship with each other that's mutually dependent. So NVIDIA invested up to $100 billion in OpenAI, and OpenAI then uses that $100 billion to buy NVIDIA chips. AMD has a deal with OpenAI where OpenAI commits to buying the chips and receives a 10% stake in AMD. And as AMD's value rises, OpenAI could then sell said shares to buy more chips, right? Yeah. So these structures inflate both sides'
these
value.
Like circular deals,
right?
Where they're kind of like inflating each other's valuations. Yeah, right. Absolutely.
And so I guess this is like, there's a bunch of different things here, and we can talk about like OpenAI's burn rate and stuff like that in a second. But I find it pretty disturbing because that, to me, we also have this on the backdrop that the growth of the stock market in the United States, it's like 70 to 80% of the net growth of the market is basically caught up in these
number.
It's mostly AI companies, and
absolutely.
that's your like your NVIDIA, for example, and all the other major players. So it's like 7 stocks. It's like really, really tiny that have been such huge winners here. Yep. So and then I think this kind of comes back into your wheelhouse.
Yeah.
which is the .com bubble, and how some of this behavior was kind of similar to that.
Exactly. So what I did was I did some research trying to figure out, okay, what were the like leading indicators that led to the .com bust? And can we use those here for the AI boom bust, potential bust, to try and predict when that moment is that we should like sell it all,
right?
know,
Yeah.
and get out of the market, get into cash, right? So I've got a few of them. Why don't I throw them out there and get you to kind of like give us your comment on it. So valuation metrics. Okay. So between 1995 and 2000, the NASDAQ rose 400%, reaching a PE ratio of 200, dwarfing the peak PE ratio of 80 for the Nikkei and other markets. So like the NASDAQ just went nuts during that time period. Okay. And then let me see here. And it peaked on March 10th, 2000, and then fell by 77% by October 2002. Right. So like over a 2-year period, it was a massive decline. Bloodbath.
Wow, 77%?
Yeah.
So if you were in it, you were invested at some point earlier on, your stocks went down by 77% over like a 2-year
So
period.
I presume you had $100 in there. You ended up with $33.
Holy shit.
That's a pretty painful lesson.
Yeah.
Right. So
wait, $23. No public math. 23, 77.
Oh, yeah. Sorry, my bad. No public math. No public math.
Yeah.
All right. Yeah. Wow. Yeah, that's way worse.
Yeah.
Anyways. Yeah, you're right. So, are we in that situation now? Are we seeing that rapid growth of the market? I would say yes.
Yeah, I would say so. Like if you were to look at the PE ratio, so sorry, that's price to earnings ratio.
Yep.
So just for folks listening who don't know about this kind of stuff, it's like the price of the stock versus the actual earnings of the
money
company
that the company is making.
Now the weird thing is like, yes, it's so speculative. I think AI is a fundamentally more transformational technology than the internet, which sounds kind of crazy, but because a lot of it's sort of built on top of the internet.
Right.
But I feel like its opportunity is really, really great, and that's obviously most of the speculation there. But at the same time, it's way out of whack. It's enormously overvalued. And there's things too with like, okay, so let's look at a specific stock. So like Nvidia, it's worth like $4 trillion is like the market cap or the valuation of that company.
Yeah.
So if you're like, what's it going to go to? Like 10 trillion, like 12 trillion? Like, what are we talking about? And then it's kind of like, well, the fundamental assumption there is that we need a whole ton of chips to do this. So it's like, well, what if it ends up like DeepSeek and we can do it with many fewer chips?
Yeah.
Right.
Yeah.
And that poof, all of a sudden that's gone.
It's the picks and shovels companies, right?
Right.
The gold rush. The people made all the money were the ones that were selling the picks and shovels to the people trying to mine the gold, right?
For sure.
So like same idea here. So the Nvidias and them are probably loving it. They're selling chips like crazy, data centers, nuclear reactors, whatever.
Like ARM in Great Britain, and like a lot. Like there's a lot of like
chip makers.
I'm sure SoftBank
AMD
has made like so much money because they are invested in a lot of these. But I just kind of But here's my counterpoint to myself. You just did this in the last episode. I don't know why we do this, but the counterpoint is there's like real stuff here though too. There are huge data centers.
Yeah.
They are building physical buildings. They have servers. They have like there's infrastructure being invested in this.
Yeah.
Whereas when I think about the .com, you can correct me, but when I think about the .com crash, a lot of it was like speculatory on like internet companies, with like foosball tables and like, nothing really there, no collateral.
Like users, but no revenue. Things like that.
Exactly.
Right? Yeah.
Kind of feels a little bit like the mobile app stuff.
Yeah.
Mobile apps still didn't have like a big crash though.
So this bullet point is valuations. So price earnings ratio is really high, way out of whack. So a little bit of this is getting hot in the kitchen.
Yeah.
Right. All right. Next one, cash burn rate. Okay.
Yeah.
So just to go back to the .com bust on March 20th, 2000, there's a cover article in Barron's, burning up fast, warning internet companies are running out of cash fast, which predicted imminent bankruptcy. And remember when like everybody would talk burn rate?
Yeah.
Now it's runway, I think is what they use the term instead. But many of those .com companies were like, what's their burn rate was their question. And like, it was like, how long do they survive until they're like out of cash and they're done?
Well, that is runway, because runway is like you're either going to take off or go off the end of the runway and explode.
Right.
Right. So
are we in that kind of situation?
Well, what do we know?
What do we know about OpenAI? If I can find the data,
I have
but
it.
essentially, oh, you have it?
Yeah.
Go ahead.
4.3 billion in sales,
Yeah.
but 2.5 billion burn rate.
Ooh.
Okay, in the same period. So it's kind of like, well, it is interesting because what people don't really get, I think, is that like a lot of these like a lot of the most popular businesses, like the Ubers, the Salesforces, the whatever, they're heavily subsidized by private equity or by the markets, depending on the context. But they're not like profitable. Like OpenAI is not profitable, like not even close.
Right.
They're heavily subsidizing the token cost so that they can capture as much market.
And I'm sure they're buying chips, they're nuclear reactors, they're looking at their costs. Like, how do we get these costs down so that we can get the economics where they need to be?
So actually, furthermore, like think about this. So they do 4.3 billion in sales, like, which is amazing, by the way.
Yeah.
But their valuation is 500 billion.
Yeah.
So they're valued at 500 billion, but they're only doing like, that's a pretty fucking awesome multiple.
Yeah.
You know what I mean? Like if we go back to the PE ratio thing. So like for me, that seems like a pretty big red flag. It also kind of like you see some of the different investments that Airbnb or my goodness, I don't want to say Airbnb, OpenAI is doing. And they're like really huge. They're like $100 billion commitments to stuff.
Yeah.
And you're like, from where?
Yeah.
Like, where is this coming from? Like how, and they're like admittedly scrambling to find ways to, generate new sources of income and all this stuff.
Yeah.
But it's also like, how are they in a position to make these commitments?
Yeah.
Like these commitments seem wildly outside the scope of what they could afford.
Right.
But then at the same time, like if they were to go to any bank, investment group, whatever, like they can go to the soft banks of the world and probably easily get tens of billions of dollars.
Yeah.
You've read the best. Now try the rest. Wait, who wrote this? Check out Startup Different on Amazon, Audible, and Kindle.
So my next point on this is ignoring fundamentals. Okay. So .com bust. So investors were willing to overlook the traditional metrics like the PE ratio and base confidence on technological advancements. Companies were valued based on earnings and profits that would not occur for many, many years, right? Mm-hmm. So I think that's another one that's happening right now. Everybody's enamored with the tech and are kind of like, wow, look at what latest version of GPT can do. And look at, Google's, video rendering, VO, like,
or Sora, the OpenAI
Sora
one too.
OpenAI one is really impressive as well. So, people are looking at that sort of stuff and kind of just ignoring the economics of the situation. So, kind of further to what you were talking about with chips and the cost to run these tokens or to sell these tokens.
Yeah.
So then the next one I have here is market concentration. Okay.
Yeah.
So when we look at it,
yeah,
it's those like 7 stocks that are really driving the market valuation right now, which is really, really scary. And so that was the same thing back in the .com bust.
I have two thoughts on this. If OpenAI fails to achieve its goals, and I think that is a broad comment, it's somewhere between not hitting financial targets and not getting to AGI. Yeah. I assume they would be first. My current feeling on who gets to AGI first is probably OpenAI.
Yeah.
I think that's probably pretty well understood. Right. But let's say they just don't really get that. They probably have they've been talking some big talks. So they got like a 5 to 10 year period, which, the money's not going to go on forever. So they have a 5 to 10 year period to figure this out or get to a business model that is, self-sustaining.
Yeah.
Maybe that involves slowly increasing the token prices. If they fail in doing that, though, is that a single point of failure? Does that indicate to the rest of the market that this isn't legit? So then you see sort of the cascading market crushing sort of effects on all these big stocks, on Nvidia, on Microsoft, on probably like Oracle, on
the picks and shovels people get pulled down with this as
just
well.
Absolutely vaporized. You would see maybe like $1 trillion of market cap like destroyed in probably a pretty short amount of time. Because as soon as that, I think we're all believing in this AI God idea in the market.
Yeah.
And there's evidence to suggest they're doing it. Like they're doing really well. But at the same time, I think once we lose that faith, like the market's going to bail fast because it's so high.
Everybody's going to run.
Everybody's going to be like, I want my money.
Yeah.
Right now.
Yeah.
Right. And it's so there's that second piece. And this is interesting. Are either those 7 companies or OpenAI, maybe Anthropic, or maybe like the top 3 horses of AI companies, are they too big to fail?
Yeah.
Are we in the category now where we actually have to bail out the market because it's so hot? You remember in 2008, right?
Yeah.
Like those banks couldn't fail because it would actually have been even more catastrophic for the economy.
Yeah.
We're talking like a deep depression.
Yeah.
Not recession.
That's a very
depression.
interesting question. So banks were bailed out.
Right.
So now
Think
are
how
we in
much
a situation
equity
where tech companies need to be bailed out because they actually, maybe the tech is so valuable they can't just disappear? Is that possible?
It's not even about the tech. It's just so much money's in it.
Yeah.
They can't have so many players fail. Because if that many players fail, everybody kind of fails.
Yeah, and then the market factors that into their investments, and those investments are worth way more because now you're too big to fail.
They're like government backed.
Yeah.
And the other thing too is kind of a semi-related point is a lot of there's I was reading an article in The Economist and there's a lot. I mean, it's snooty. Like, you know, as I was having my morning tea.
Okay.
And there's a lot of interdependency in American securities right now because of the AI boom. So, like, a lot of European investors are invested heavily in the US. Like a lot of Canadian investors, a lot of Japanese investors.
Oh, yeah. It's global.
So, like, it's a global risk concentrated in like 7 stocks in the US, plus the private equity in AI.
Yeah.
And that's kind of terrifying.
Yeah.
It's really high concentration risk.
Yeah. So the other thing I want to put out there, so my next point that I want
I don't
to
want to lose
my
money, man.
Yeah. So back in the .com bust, there was a lot of easy money because interest rates were low. Okay. Are we, I think the Fed is making an announcement tomorrow, same with the Bank of
Interest
Canada.
rates will be low.
And I think interest rates are in both countries are going to go down. So are we getting into a period where the money is getting too easy as well for these companies to finance them, so that you're just sort of like encouraging this unbridled investment into these companies without actually looking at the fundamentals because money's easy to get to?
Well, yeah. I mean, like if you make money cheaper, then there'll be more money, right? Like this is the point of that kind of economic lever. We don't have our other brother here, but I'm pretty sure he would be like, if I can speak for Mike.
Yeah.
But I just think that that just points me to another risk. At the same time, like I do think low interest rates make sense for other economic reasons, but it is kind of like, obviously that's like pouring gas on the fire, right? It's just going to intensify the investment. If you're a private equity, I mean, I think one of the reasons we were made the offer we were made back in 2021, really,
2022,
and then 2022, is that money was real cheap.
Yeah,
you know, like during COVID, like money was incredibly cheap.
Yeah,
and there was there was actually a lot of like fledgling like venture capital offerings. Like private equity groups were struggling to turn over some of their investments because a lot had changed in the market since they made the first investment. So they were looking for opportunities, and we happen to be a high growth company and all those sorts of things. And it worked out really well for us. But that, like, to me, it was just, there was a ton of money flying around.
Yeah.
Like I remember some of the strategics in our market, other than the one that bought us, that were making like 6 or 7 acquisitions a year.
Yeah.
And during the peak COVID years.
Yeah. Because money was so
cheap. It's easy for them to do it.
Yeah.
So I do think it is a big risk there as well. So I don't know. Like this is starting to like legitimately freak me out. Yeah. The other thing, like too, I just want to get back to that concentration risk on like how a lot of people are invested in U.S. securities. The other thing is like one of the good like portfolio theory things, right? Is like geographic diversification of assets. Right. But it's like, well, how am I like? What does it matter? Like, so I buy a bunch of stocks in a European company. All those European companies are invested in the U.S. market. Yeah. Like, I kind of feel like the principles that make good investments are also at risk because of the concentration risk in the United States. Yeah. It's like way beyond just like what an individual investor can hedge against, except for maybe like being a silver stacker or like buying gold, maybe to preserve value. But
all right. So going back to the .com bust, I've got.
Do you know? Hang on. Do you know what a silver stacker is?
No.
Not to interrupt you.
What is that?
Okay, so you know how like this is fun. I don't know if Graham knows this either. So gold is like you want to make sure you actually buy gold when you buy gold. If you go to a bank and say I want to buy gold, they'll give you like they sell you like a share of like gold, but like lots of people own that gold, so they resell the same thing.
Oh, they wait until you actually say you want it when they then go and buy the gold.
Yeah, there's stuff like that. Like you can actually
like you don't like you have like a promise that they will give you gold.
Yes, so you can go to the Canadian like mint, or I'm sure there's an equivalent in the United States. And you got like gold. I'm pretty sure. Anyway. But so here's the trick with silver. The silver is the same idea. You're trying to preserve wealth as well. But the silver stackers, this was my neighbor who told me about this, who was really deep in it. He's like, it's these guys who just buy a ton of silver, and they literally, because its value is so much less than gold, they have a ton of it. And they have the actual gold. So they stack the silver. They're silver stacking in their basement or something. So they just have like big piles of silver.
That's a bad idea.
Just a terrible thing. But it's interesting. Anyways.
All right. So my last two, like, predictive indicators for something for the market going belly up is they're kind of the same. So excessive hype, retail investors, and then like an IPO mania type of situation. So do you remember back in the housing crisis? Remember, like random people were buying like 2 and 3 houses, okay? And
like the stripper in The Big Short that owned like 8 houses or something, and it was all on credit.
Exactly. So like that kind of stuff, and then the IPO mania pieces. So I have a question about this because I should know the answer to this question. But is OpenAI is not a public company?
No, they're not.
They're private.
We talked about this. Like they're all private, which I find really like weird. But it's because they can get access to such capital privately. They don't feel like they need IPO.
Right. Yeah. So, okay. So let's assume all those indicators that'd be
quite the IPO.
Saying, yeah, this is scary. Like we're on the verge of a bust. Okay. But is this time different? Like we ask this sometimes with other things to do with AI. Is this different than what we've seen in the past? And I kind of wonder if it sort of is like kind of like those counter indicators are, well, if OpenAI goes belly up, is it just all the investors that have invested in the private equity that are going to lose their money? Now, it's still people that have invested in it, but does it not affect the market at large? Or does it? Because all the picks and shovel companies are public and are selling chips and nuclear reactors and all that sort of stuff to these AI companies that market is now gone. And then the market has a big contraction because of that. Is that kind of the way you see that playing out?
Yeah, like I think the easiest answer here is like I don't know, but classic.
That's great.
How about a business answer? It depends. I think that I kind of think of it a little bit differently. Let's assume go with me here for a second. Let's assume OpenAI or one of them is successful.
Yeah.
Okay. So they figure this out,
like AGI.
Okay. And they get to the goal.
Yeah.
What happens to the chip companies then? What happens to the picks and shovels then? You know what I mean? What is the roadmap?
You're such a pessimist.
I don't know. I'm just saying.
You're always doom and gloom on the.
I'm just saying.
I'm gonna be positive. Like, what if they do it and we cure cancer?
We go to the moon. You have an AGI. It's incredibly intelligent. You got all this horsepower behind it. You have 20 nuclear reactors, and then you go, "Hey, how do I spend less money on chips?" Like, I don't know. Like, isn't there some element of like, if it's this all-knowing machine god, couldn't you go and be like, how do I drive costs down?
Here's quantum.
Yeah. By the way, here's quantum computing. You don't need any
chips.
Yeah, done.
Yeah. This is the thing.
You need one Q chip, versus,
Is this time is different argument? Is that where we're getting to with this? Is that we can't necessarily use the indicators of previous, recessions, things like that, in this scenario because of AI, and is just such an unknown. It is a singularity. We don't know what's past that moment. Is that where we're at?
I think it's a function of time. I think if they can reach whatever their end goal is going to be, profitability or AGI or both or whatever, in the next 5 to 10 years, then this time is different. If they don't reach it, I think you see tremendous market collapse.
Yeah. All right. So let's go right back to the original question,
Sick.
which was, when do we sell
Yeah.
to get out? Because so what are the things
I would say that the right time to sell is, all right, folks, we'll see you next week.
No, get in there. Get in there. I got a couple of red flags I want to put out there that I think that
I would have loved to have cut right there.
the music.
Yeah, start it up.
Let's get it rolling. All right, not yet. Okay. All right. So here are Chris's red flags on when to sell all your investments. Okay.
Okay.
Watch for the first major AI company to miss their commitments or default, or like said they were going to get something from.
The market will tell you when that
that's
happens.
That's one. Okay. All right. Insider selling. Executives
for sure.
cashing out.
Yeah.
Okay.
For sure.
Track that stuff really carefully. I don't know how you do that if they're private, but anyways, monitor the financing terms as they get more like desperate. As they get more, we need that cash.
I could see them IPOing
we're gonna give better
when they
terms.
need cash,
Yeah.
because everybody will want to invest in them.
Yeah. And then I think there's going to be a trend of we're going to start to see the news stories of, hey, OpenAI like missed this, Anthropic missed this, that sort of stuff. Those like that Barron's moment that
agreed, yeah,
that we saw in the past. So like those are kind of like the when my spidey senses start tingling is when I start hearing some of those things.
I think when you have whistleblowers are talking about this thing is the real deal. And we're concerned that they're not taking safety seriously.
Yeah.
When the whistleblowers change to this is a hoax, is probably when you can start considering selling off or pruning the garden a little bit, and maybe getting a little take of the high end of the market. Keep a little bit in there, and when you see the shit starting to hit the fan, make sure you're at your computer or your phone and ready to hit that sell button in a fucking hurry.
Yeah. And with all this being said, maybe this time is different. You shouldn't sell it all and just ride it. I don't know. We've really solved some things here today, haven't we?
Yeah. Start it up. Let's get it rolling. All right, we'll see you next week, folks. Bye-bye. Hey.
Start it up. Let's get it rolling. Big ideas, money folding. Hustle smart, dream so wide. Turn that grind into a joyride.